This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Now, joining us again in the Postgame segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Jim's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a build this week of 2.9 million barrels, Cushing, Oklahoma building 1.7 million barrels, gasoline building 2.7 million barrels, distillates 1.5 million barrels, again a build. So it's builds across the board. Meanwhile, U.S. production ticked up 2 ticks to 13.3 million barrels. That is an all-time record high. It's not the first time we've been at 13.3. We've been there before, but we've never been to 13.4 so far as I know. So this is back to the prior all-time high. Shipping disruptions in the Red Sea and a U.S. military strike on the Houthis, who were believed to be responsible for those attacks on ships in the Red Sea, have the market on edge about the possibility of a geopolitical escalation. When I taped last week's show, we were still just barely below $70 WTI, and I said we really needed to get above $80 before we could declare a new uptrend to be in play. Well, we got halfway there this week, with the market briefly trading over $75 early on Wednesday, but we still have a long way to go before we could say the trend has reversed. At this point, with more and more signs emerging that the Biden administration is focusing its policy decisions on election year politics, I don't think the U.S. will do anything aggressive to risk another upside oil price dislocation before the election. And for now, at least, the supply constraints that I and many other analysts have been concerned with have not materialized in the data, suggesting that more black market oil is in the system than official statistics reveal. There's definitely a vulnerability, though, here in the sense that enemies of the United States understand the Biden administration's hesitance to risk higher oil prices in an election year. So I think the risk of geopolitical escalation being provoked by Venezuela or in the Middle East, not by the U.S., but by other parties who know that the U.S. is going to be slow to respond, is probably higher than some analysts perceive. But the bottom line remains that the Biden administration has a very strong incentive to do anything it can to avoid higher gasoline prices, and I think that's what they're going to do.
Yeah, Eric, that $75 level was much more of a focus for me. The 80, I certainly agree, would be that if we manage to beat the $75, $76 area, there's a fib retracement zone, the 50-day moving average, all sorts of things that are typical resistance levels. And if the primary downtrend of crude oil is not over, this would be a typical place for oil to roll over and, let's say, go and retest the lows or something of that nature. So this is an important make it or break it moment. If the bulls really are transitioning this to a new bull trend, a move to 80 and then consolidations that stay above 75 would be where a lot of technicians will be getting buy signals, and it could change the trend on crude from there. Anyway, Nick, I want to get you in this conversation. Let's talk about equities. What levels are you watching on the S&P here going into the holiday week?
Yeah, Patrick. So right now, the spot price on SPX is approximately 4,700. We have a call wall above at 4,800 and a put wall right where we're at right now at 4,700. The implied move for the January 19th monthly OPEX is plus minus 120 points. This denotes an upper expected move of 48.20, which is right around the all-time highs, and a lower expected move of 45.80. Right now, key resistance is above at 4,800, and key support is right where we're at right now at 4,700. Again, I mentioned last week, I thought we would test out that 46.90 area, and we're almost there right now, possibly as low as 45.90. I think that's still in the cards. Yesterday, we had a very sharp sell-off from 47.75 all the way down to 46.95 area. So that didn't really surprise me at all. I expected at some point in time we'd see a volatility event. There was no actual reason for that. I heard speculation perhaps that a hedge fund was offside shorting 0DTE puts on SPX. Possible reason why, because we had a very, very rapid sell-off into close yesterday. Again, I'm inclined to think that we see some more upside back to that 48.50 mark, perhaps, new all-time highs, before seeing some downside after the January OPEX. What are your thoughts?
Yeah, listen, overall, the S&P 500, I think, is like in the 7th, 8th innings of the advanced part, which is that we're reaching all-time highs. We're very overbought. And this is a typical place where the market tends to pause and retrace or backfill or consolidate the advance. Very similar to November and December of 2021, where the last major high occurred. It spent over 2 months, just more or less trading sideways before ultimately the market turned. And so in my mind, while we are certainly reaching overhead resistance, it doesn't mean that the downside window is going to open in any way. With us being in the middle of the holiday period, I would expect that this is going to start behaving far more trade range bound as we move forward. What's interesting though, Nick, is on page 5, I put the percentage of stocks above their 50-day moving averages on the New York Stock Exchange. It's just a way of observing the breadth of the market. And when we had this chart up several months ago in October, we were talking about how incredibly oversold the market was, because obviously back then only the fangs were working, the breadth of the market was horrible, and that ended up being a level that marked the swing low or the short-term low of the market. And then you can see now in the last 2 months, we've seen the exact opposite. We've literally now come to some of the most extreme overbought readings based on this metric. And typically, even though that doesn't mark a specific top to the day, this just depicts the fact that this market has already had this bullish impulse and it's likely to pause and reverse at some point. The bigger question, if it does pause and reverse, is it just going to be a typical correction, or is there something going to happen that's bigger? Overall, though, Nick, I think that if there was going to be something that's more pronounced to the downside, it's probably going to wait for the first few weeks of January, and it's likely that the next 1 or 2 weeks is going to be far more like watching paint dry.
Yeah, I'm definitely in agreement. I think the last few weeks of the year and the first couple of weeks of January will be pretty dry as well as we head into that monthly OPEX. I think following that OPEX, we're going to see a lot of volatility, possibly a decline of 5% plus across major indices, especially in tech, which we're onto right now. So spot price right now in Qs is 405. There's a call wall above at 410 and a put wall just below at 400. Now, the implied move for the monthly OPEX for January 19th is plus minus 14 points. Therefore, the upper implied move is 419. The lower implied move is 391. We currently have key resistance right now at 410, which are all-time highs, and key support below at 400. As I said in previous weeks, I do think tech is overextended. Obviously, I think with it at all-time highs, I've been wrong. But the key point that I've been making is that the small caps are the ones that are undervalued and are outperforming, which they are. Look at IWM. I think that's where you want to place your bets, perhaps into January OPEX and not into big tech. The reason being is that I feel like big tech is very, very overbought. I feel like most funds are over allocated on these names, and they're going to sell them off in the new year in favor of buying the small caps.
Well, you know what? I want to move on and talk about volatility because while there was obviously a big downdraft on an intraday basis yesterday, the interesting part was the VIX did react, but it's still at incredibly low levels. I mean, we're at the 13 handle, which is a level where we spent most of the last month. And so it'll be interesting to see whether or not this correction actually spurs something much more in the mid-teens on the upside. How are you taking the VIX here?
So I figured the VIX at 12 was pretty low overall. Again, it could stay there for a few weeks, but at some point in time, we're going to get some exogenous event that's going to cause a pop. Yesterday, there was no actual reason for the pop in the VIX. But that being said, when the market is up almost 10 days in a row, you can expect that at some point in time, there will be some sellers to come out and sell off heavily, right? And all it takes is some selling to push us lower. And with the gamma flip on the put side, that can cause an exacerbation of the move to the downside. So for example, with the 0DT puts yesterday, there were some 47.50 puts that were only 15 cents leading up to close. What happened into close there? We fell, they went in the money, and those puts expired worth $55 each. So that's a crazy, crazy exaggerated move to the downside. And what happens is that once those puts get in the money, market makers are forced to cover their positions and essentially hedge against those short puts that are going to expire and cash settle. They're forced to therefore short futures, which pushes the market down even further. So it's kind of the opposite effect of what we've seen the last few weeks, where we've seen a grind higher and calls go in the money. Market makers buy S&P futures, pushing it higher, and there's no sellers at all, right? So total opposite effect. I think the VIX is still very low overall, and into January, February OPEXs, I think we're going to see a pop towards 16 or so. That's why I think it's very, very risky to sell short-term options. I've been saying this the past few weeks. Selling premium is not a good idea when the VIX is low.
Yeah, it's interesting. Like the one-day volatility index actually had a pretty significant pop, though. I mean, we were down in the single digits and now had a quick pop toward the 14, 15 level. Anyway, Nick, I wanted to move on and just touch on the dollar index. And what's interesting to me is the dollar is clearly still in distribution mode. The lower highs, lower lows, every time it pops a little bit, it comes right back down. I think the window remains open to retesting the bottom end of the range of 2023 down in the 100 to 101 range. The bigger question with the way that the Fed has advertised and their dovish position, it's going to be interesting to see whether that creates a much more prolonged, pronounced distribution cycle in the dollar that may even see it go under 100, or will the dollar generally fade this weakness? Right now, going into this holiday period, I see some downside risk, but as we approach that 101, 100 level, it'd be interesting to see whether a more meaningful short-term low is established.
Now, moving on to page 9, we have the gold futures chart. Eric, what are your thoughts here?
There's a very clear resistance level at 2063 on the February contract, and the market has bumped its head on that level several times this week. The chart point resistance is clustered between 2063 and 2085. So if we can get above 2085, the move should accelerate to the upside. And so long as the Fed doesn't have another public display of mood swing, so to speak, I think the fundamentals are supportive to eventually break through that resistance band and move higher. But the slow stochastics that were badly oversold next week are now back to just modestly overbought. So any sign of mood change from the Fed could easily bring on a sharp downside correction. Gold corrected downward in sympathy with equities on Wednesday afternoon, but not as deeply. So for now at least, the FOMC dovish pivot narrative is still in play for gold, and maybe it's still in play for equities. We'll see what happens. Anyway, let's see if it holds.
For me, I'm keeping this super simple. All these major highs were in that 2075 to 2085 level. And if gold is ready to make a more meaningful breakout to, let's say, 2300, it's got to clear that hurdle. And right now, we've been week after week just consolidating below it. And we haven't seen that real breakout that is going to advertising that next leg. But with the fact that the dollar is as weak as it is, I still leave the window open for a breakout, but that's the key hurdle, and we're going to watch to see if it breaks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.